Make no mistake, there's blood in the water. While these rate hikes are having tangible negative effects in our markets, the Federal Reserve is dead set on combating inflation and returning price stability to the American public. What's going on, guys? It's Nate Clark, the skydiving real estate agent, your Central Texas realtor. That means Austin, San Antonio, and everything in between. Today we're here to talk about one of our favorite hot button issues of discussion for 2022, more rate hikes. The Federal Open Market Committee met November 1st and 2nd and just raised the federal funds rate 0.75% to a target benchmark of 3.75 to 4%. Markets were already expecting a 75 basis point increase, so those were pretty much baked into the cake already. It's funny to look back in time and compare these Fed meetings with 2014, 2015, when it felt like the reporters were always asking Janet Yellen, when are you gonna raise rates? When are you gonna raise rates? And she would go, not yet, not yet. And now the script has flipped a little bit. It's Jerome Powell this time around, and the reporters are asking, when are you gonna stop raising rates? When are you gonna stop raising rates? And he's going, not yet, not yet. The 75 basis point bump was expected, but the fact that that's actually more substantial than today's rate hike is the signaling we're getting from Powell and the FOMC about rate hikes moving forward. Economists had previously predicted a terminal Fed funds rate of about 4.6%, meaning the max that it should have to go up to for us to curtail inflation. Being that we're currently at 3.75 to 4%, that would give us another 0.6 to 0.85 worth of rate hikes to go. Recently, Fed funds futures have begun pricing in a terminal rate of 5.25 to 5.5% rather than the previously expected 4.6%. This means that there's more pain to go, and we might see further additional rate hikes as high as 1.5 to 1.75%. There are three important questions that Jerome Powell answered during this meeting. The first is, how quickly do rates need to go up? Well, Powell signaled that we're entering restrictive territory, and he said it in such a way that you can tell Powell believes we're already in a restrictive inflation fighting place to be at, but it's no time to take our foot off the gas. We believe that the slowdown of rate hikes would happen in the next two meetings, potentially, rather than automatically assuming that we're going to drop back to a 50 basis point hike in December. But at the same time, what this could mean is just lower and slower rate hikes of a quarter point at a time, still getting us up into that 5.5 to 6% range. That brings us to the next question. How high do rates need to go? Well, based on today's meeting, we've got a ways to go. And you can't exactly forecast where the terminal rate will end up, but if Powell is going to give you an update, he'd tell you that the terminal rate will be higher than we've previously expected. We need more updated CPI data to come back and help inform these decisions, but Powell's comments were very much in line with Fed's funds futures pricing, suggesting a higher terminal Fed's fund rate. That brings us to the third question. How long do we need higher interest rates to return inflation to the Fed's 2% target? Ultimately, this is the trickiest question of the three. There are inside and outside lags to economic and monetary policy, and Powell pointed to the chain of activity as it actually happens. First, the Fed acts, then financial conditions tighten, then business economic activity tightens, and consumer economic activity tightens. Once business and consumer economic activity have tightened, that's when we're actually able to start fighting inflation and it starts coming down. Certain markets like the housing market are more immediately rate sensitive, but the economy as a whole will take some time to work the kinks out. Now, at first glance, this sounds really positive. The restrictive conditions might already be at work. CPI data and inflation might already be coming down and improving. Unfortunately, what the markets didn't like was Powell's comment that came directly after this, where he effectively said, if in the worst case scenario we over-tighten our economic conditions, well, we can always turn the money printer back on and stimulate the economy. So this is not what the markets wanted to hear, because basically what Powell is saying is that they would rather over-tighten than under-tighten. So he sounds dovish at first. He sounds like he's saying, well, this CPI data may already be reducing, inflation may already be coming back because of these inside and outside lags. But then he very quickly follows it up with the hawkish sentiment that we're not sure, and if we have to, we'd rather over-tighten than under-tighten and turn the money printers back on. So to recap, the Fed hiked rates 0.75%, which the market was expecting. Rate hikes are expected to slow down in the next two meetings rather than an automatic slowdown at December's meeting next month. The terminal Fed funds rate is likely higher than previously expected, potentially in the mid 5% range rather than 4.6%. And Powell said, we haven't over-tightened yet, but we'd rather over-tighten and stimulate rather than under-tighten and risk inflation becoming entrenched. I hope you found this information valuable. If you ever want to talk interest rates, talk houses, look at houses, or go skydiving, give me a call, shoot me a text. My number is 512-757-7325. Other than that, I hope you're enjoying the weather today and have a terrific rest of your week.